Hey everybody, welcome to the Blind Ambition with Jack Kelly. It's Rick, and today I have Joe Apprendi with us. Joe is the founder and general partner of Revel Partners, an early stage venture capital fund focused on B2B software as a service company. So I think our audience will appreciate this in particular. Joe was an operator before becoming an investor. In 2006, Joe founded the ad technology company Collective, which was acquired by Zeta Global. He was the CEO of North America at the ad tech company Fox Solutions, which DoubleClick, now Google, acquired. And throughout his career, he's been responsible for sales and marketing at other ad companies. So thanks for coming on the show, Joe.
Happy to be here. Thanks for having me.
And hopefully I did your illustrious career path some justice, but I was wondering, can you provide some like extra context for us? Like, how did you get into the ads industry?
Well, I'll try to give you a short version. It was kind of fortuitous, I would say, and random. But I graduated from Oberlin College and attended NYU as well, and I've been in New York ever since college. I originally thought, having graduated with an economics degree, I was going to be in the finance business. Ended up at a commercial real estate investment company, briefly, really doing kind of outbound scans of available warehouses and manufacturing facilities that look the good investment properties, actually in Queens and Brooklyn. But I grew up in an entrepreneurial home. My father was a two-time founder of two different software companies. So throughout my childhood and college days, kind of entrepreneurialism was really kind of woven into my psyche very early. So actually, when I was at this company, one of my fraternity brothers at NYU and I started a business called Flight Video. Very early on, we actually did a press release before the company was even founded. It was picked up by USA Today in the business travel section. I'm not going to tell you in detail what the business did. And we ended up getting inbound interest to invest, which we raised, you could call it pre-seed capital back then to kind of start this business. And, we embarked on that endeavor for a couple of years, learned a lot about the video content and ultimately the ad-supported business as a result of that. While that business didn't take off and we ended up having to find real jobs, my father actually introduced me to a friend that had a magazine called SF Magazine, and he needed somebody to sell advertising for that magazine in New York. And that's kind of got me into the ad business, which ultimately moved quickly into broadcast television.
So when you go for television, what kind of ads did you do? What kind of
Yeah, so I worked for a company called MMT, which was owned by Cox. I'm sure you're familiar with Cox Media. Very large enterprise, owns television stations, radio stations, newspapers throughout the country. This was their television firm that represented stations throughout the country on a national basis to sell the advertising to large agencies in multiple markets. I happen to be in New York, and that's kind of where I learned the business, grew in the business, enjoyed it. But I was bitten by the internet bug very, very early, really in 1994. And I was encouraging the company to get into internet ad sales when the kind of first banner ad was sold on Hotwired and Yahoo. How can we kind of build that digital advertising business to complement what we were doing in broadcast? But I don't know how long you guys have been around, let alone involved in digital media, but a lot of people thought it was a fad. I mean, people were dialing into the internet through AOL. Page load times were horrendous. Ad load times were just as bad. And when I actually tried to present this idea to get in this business and actually show them for the first time what a digital ad looked like or a banner ad, AOL never connected. So I had the
Right.
CEO and the executive vice
Oh,
president, along with my partner at the company that we were founding this company with, uh, uh, sitting there, not being able to communicate exactly what we were talking about. So quickly they kind of said, that's great, Joe. Good luck with that.
yeah.
But clearly I stuck with it, and I ended up founding my first company, which you didn't mention, which was called Click Now, which was a digital ad rep firm that was acquired by 24/7 Media, which went public in 1998, which was actually the direct competitor to DoubleClick at the time.
Wow.
So that's kind of how I got into digital and ultimately into ad technology, which ultimately enabled digital advertising.
So when you started, did you have to go to that meeting? First of all, you had that annoying dial-up noise that would squeal, and then
I
when
was
you
the
said,
only one in a company with a notebook computer.
and did you have to go www dot wait no http backslash
Oh yeah.
www? So did you have to do that at the
Well,
time?
I didn't even get that far. So it never. They
Oh no.
they got to hear the dial in connection noise,
Uh,
but that was it. It never actually connected.
so from that auspicious beginning, it could only go up from there. So that was the positive side, right? From there, it's all upside.
Perseverance.
Yeah.
I mean, speaking of like perseverance, right? Like, so my understanding of the ads industry is it can be volatile, right? Like there's a lot of new industries. There's kind of these like external forces in terms of, do marketing budgets, do your prospective clients have the budget to spend? And so how have you seen the kind of ads industry kind of evolve over time and kind of adapt around these kind of external forces there?
Well, kind of, Web 1.0, which is kind of this time frame when digital advertising was kind of test budgets from major brands, but were the majority of the budgets for the, Web 1.0 companies, many of which were all venture backed, right? Private equity backed. Some went public, including 24/7 Media. Many of our clients that were spending the most money were companies that were primarily funding operations through capital infusion, not with profitable business models. So the volatility at that time was largely a derivative of the advertiser base. It wasn't really your Fortune 1000, top ad spenders in other media. So we were highly dependent upon that and those companies. And as obviously we all know what happened in the 1998 through 2001 time period, when all those companies went under, not all of them, but many of them, budgets dried up, which obviously put pressure on anybody in the digital advertising ecosystem to kind of continue to grow their businesses. Those that survived actually recognized their dependency on maybe these fledgling technology businesses that were funding their ad supported businesses, and went to kind of diversify the revenue with true leading brands in all advertiser categories. So 24/7 did survive, fortunately, even though, peaked at 69, went down to $1, under $1 in the stock, and was touch and go for a long period of time, but ultimately was acquired by WPP, which is one of the, obviously the largest advertising agencies in the world.
That has been a really tough time seeing it go down to $1.
Yeah, it was painful. And obviously, I think you're seeing some of that. And obviously, I was there firsthand during that period of time 20 plus years ago. Now you're seeing obviously many of these high flying ad technology stocks, let alone B2B software companies in aggregate, down 50 to 80% from their all-time highs. That is extraordinarily demoralizing, obviously, for people, where obviously a high percentage of their compensation is directly linked to that stock price. And it's very difficult to manage. And it's very difficult to remotivate people, in these situations. And that's obviously the upside is the stock grows. The downside is it drops, and all of a sudden you're dealing with an HR problem.
Do you see parallels to what's going on now? Not exactly the same way where, there's kind of an everything bubble, running from cryptocurrency trading to startups to these, unicorn companies founded by people who are 12 years old and just throwing cash at it. And now it's looked like the air's coming out of it.
Well, I think the only parallel I would say, and I can't speak, I'll leave crypto aside, but I think in the software technology landscape, I think the only parallel is that valuations have gotten ahead of themselves. When you got a low interest rate environment, when investors are doing discounted cash flows in a competitive private equity marketplace, multiples go up dramatically. I mean, when you're investing in businesses, not, that you used to invest in at 10 times forward ARR, and then all of a sudden, it ramps to 100, something's off. So those valuations are getting reset. However, the businesses are very, very different. I mean, digital is imbued and embedded in enterprise decision-making, obviously software as a service and marketplaces that streamline and automate workflows and enhance productivity. It is measurable. Enterprises are 100% bought in. So we're not going to see any of this go away, but you may see, valuations being reset and money being raised in a down round capacity versus kind of up round after up round.
So for the people involved with these companies, it's obviously rough, but do you think it's long-term healthy that you wring all the excesses out and get it down to some sort of normalcy so that moving forward, we would see a more reasonable economy, not based on just artificially low interest rates and cheap money available. So it just goes back to kind of where it would be
Well,
without
it doesn't.
the Fed. Yeah.
Yeah, I mean, I don't think it feels healthy while it's going on.
Exactly. Right.
And then I don't think anyone would prefer to deal with such a quick downward spiral in valuations and how that impacts, an employee's expectation in terms of, how they're going to be compensated for their efforts. But it's absolutely necessary. I don't know how you avoid it. It just market forces dictate that. It's very difficult for a single company, let alone an industry sector overall, to dictate market conditions. The things I have advised, and I've always advised in good markets and in tough markets, the CEOs and founders that we see day in and day out and consider investing in is try not to get ahead too fast on your pre-money valuations. I can tell you, we pass on companies, not, and have passed on many companies in terms of making an investment strictly on valuation. We felt the team was great. We felt, the TAM was amazing. We felt the problem they were solving was real, and they had an opportunity to displace an incumbent. But if the valuation was 3 times where we thought they should be at this juncture and maturity in the business, we had to steer clear. And as an investor, it's difficult saying no even before you're an investor. But once you're an investor, it's even more difficult because it can be construed or perceived by the founder and CEO if you're not participating with your pro rata that you're unsupportive or you're not a believer. But we try our best to communicate it, on that facet of the decision, it's strictly economics. And 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 while we can't control how other private equity and venture capital firms perceive value, and obviously entrepreneurs would love to, be less diluted than more diluted, hence higher pre-money versus a lower pre-money. But in the long run, it's good to be prudent, so you don't get ahead of yourself, so you don't have to get reset. Because again, when you reset it, even as a private company, all the employees also are affected by that. You've got, their 409A exercise price was X, and all of a sudden it's dropped versus gone up. So their perceived value of equity is dropped accordingly, and then they start getting concerned about the go forward strategy and outcome of the business.
Now,
Do you
in your
have any insight?
specialization with, oh, I'm sorry, go ahead, Rick.
Oh, no, no. Do you have any insights into what is causing this kind of like, or was causing this kind of rush for this like inflated valuations? Like, how did we get to that level? Was it just kind of like the myth of like
So
infinite
it's
growth?
it's strictly supply and demand. There, despite where we are in public market valuations and the downward trend in these sectors, there's never been a time prior that venture capitalists and growth stage private equity has had more capital to invest. So even though at this juncture, certainly venture capital firms and private equity firms are being more cautious, and valuations are going down based on the same metrics that may have been they've been evaluating a year prior. But at the end of the day, they're managing money and they have to deploy it. So when you're managing money and you have to deploy it, and you're one of 1,000 venture capital firms in the same boat, valuations can always tick up.
Interesting.
In your specialization for SaaS companies, does that hold up a little better because it's based on subscriptions, or it just you get caught with everyone else?
Well, if I were to walk you through the Revel investment thesis and our deck, absolutely. One of the reasons we decided to focus strictly on B2B and not B2C technology, it's not that B2C technology companies aren't exciting, and there's massive winners and a number of unicorns in the space. That's where our expertise lied, number one, as founders and operators, and certainly our investment track record. But when you actually look at how they're impacted, in both in terms of secular tailwinds or secular headwinds, they perform better. They're more recession proof. The return on capital multiple is higher for every dollar invested. When you take a look at all the B2B technology companies that went public versus their B2C counterparts. And the big reason of that is to your point, is not just that it's subscription models, of course it is, but enterprises that invest in technology, right, usually for mission critical functions. As a result, they're very difficult to displace. They've got, enterprises have thousands of users trained and utilizing this UI from a workflow and insights and analytics perspective. So it's difficult for them to not continue to leverage that platform long term. Whereas in B2C technology, you can always say, I can't afford Netflix anymore. Or, I got to pick Netflix versus HBO. It's discretionary spending. We try to invest in B2B software companies that are invaluable and that have sticky users that can't do their job without it. And you don't want to like, the switching costs are so high for the enterprise that it makes sense to stick with this company despite whatever the economic environment is, because ultimately they're going to be more productive with the solution versus not.
So that's a smart decision. So once they have the service, it's not as easy as just, saying, I'm going to cancel Netflix, I'm going to cancel, whatever it is. You have it. I don't want to say you're stuck with it, but it's like, it's part of your work life and you're used to it and you're going to keep it. And kind of, I guess it doesn't make you immune to market forces, but it certainly puts a moat around it, which makes it much better.
Absolutely. And I think that, one of the attributes that we really focus on and appreciate when we evaluate these businesses is that UX. And, and what's interesting is that we actually evaluate the viability of that B2B platform based on a lot of these direct or B2C metrics, whether that's daily active users, weekly active users, monthly active users, time spent. These usage metrics really represent how sticky and how important that solution is. It's not always their license fee. We see it time and time again that they may have early adopters of their solution among leading enterprises, but the usage metrics aren't there. And if the usage metrics aren't there, they're likely gonna, churn those customers. So we really focus on those usability metrics and time spent metrics as a testament to how important that solution is to the enterprise.
Joe, are there any companies in your portfolio that you're open to sharing? So maybe we kind of get a sense of the type of organizations.
I mean, I could point out a few. I mean, one of them obviously within kind of our operating background, and we now obviously invest in all kinds of industry and application sectors, but our heritage has been in the marketing technology space. And just to kind of add to that a bit, one of the reasons why we thought Revel was very, very unique, not just because of our operating background, but specifically because of our operating background in marketing technology. One of the first industries to be completely reinvented or transformed by data, workflow, automation, analytics, marketplaces, and self-service technology on the buy side and the sell side was advertising, programmatic advertising. So we thought everything that happened in the marketing sector of as an enterprise use case was happening in all other kinds of operating sectors, whether that was sales or logistics or e-commerce, you name it. So we thought we were in a unique position to see how those attributes applied to other B2B technology solutions. But to name a company specifically that happened to be in the marketing technology sector, Placements, there's a company that we invested in, actually one of our earliest investments in Revel 2, was an order management platform for media companies, right? Basically how their sales organization engages with their advertisers. They need an automated system to, take in orders, move orders into their ad delivery system, analyze what's delivering on time so they don't leave money on the table, determine yield on an advertiser by advertiser basis, reconcile that based on what they're seeing in real time versus what they're going to get paid for on based on the metrics the advertiser is measuring them against. So this is a system that the whole enterprise at the media organization, and now even on the marketer side, is leveraging to really account and manage their entire advertising revenue or investment. So this is an example of a very sticky application. In a different sector, a company like Fetcher, again, a company we thought we were uniquely positioned to invest in based on kind of, again, this marketing technology DNA. They built a solution, especially as we're, as we know, there's so many open jobs out there right now. There are, a variety of different applications, employers can use, both third-party recruiters that are very expensive in the services space versus kind of self-service technology solutions like Indeed, for example, maybe for lower level or kind of cross-industry type of job positions. But if you're looking to fill bespoke jobs, but do it with AI and data and automation and really reach out versus wait to see who comes in inbound for your job postings, this company actually can identify HR or personnel targets, much like you would identify a target for your advertising campaign that would be likely a great fit for any role in your organization, and manage that whole workflow with an end-to-end CRM solution from outreach all the way to onboarding.
So that's really interesting. So what it's, I'm sorry, what was it called? Fetcher?
Fetcher, yeah. Fetcher, yeah.
Yeah. So, because I've run a search firm executive for the last 25 years, so I kind of know about the space. And it sounded familiar when you mentioned the name, and I wasn't too familiar. So does it focus on any specific niche within the job market, or?
I mean, no, they probably haven't moved successfully into the executive or the C-suite
Right.
yet, but pretty much every level down across every industry vertical. But they certainly, to your point, have done a great job in the product and engineering sector, which obviously is an area that you need to do a lot of outreach to identify talent given the competitive environment. So that actually happens to be one of their biggest sectors or
what they
job
use,
categories.
you said they use AI to kind of find candidates, or it's a matching
Exactly. So
platform?
if you've got your job, you got the company attributes, you got the job description, and then you've got obviously the resume of the prior work history of the individual. You've got all that, but plus you've got other signals that they can detect, not just on LinkedIn, but other platforms that might indicate they may be thinking of moving on, more opportunistic to switch versus less opportunistic based on maybe time spent in a particular role, not yet promoted, things of this nature, plus all the success that they've had recruiting similar people with similar profiles. They can leverage all of that, right, by crunching that through machine learning to ultimately say, wow, this person looks just like that person. And ultimately, they're going to be a good prospect for a similar job description that we successfully hired another person for.
Yeah, it's very active, that space. There's a lot of attention being paid. I was just speaking to the folks from Hired the other day, and they kind of have a similar platform where instead of having the old school recruiting try to find it, it basically will match it up through artificial intelligence, where here you have a software engineer, software developer, here's the company that's looking, and then kind of just put it together through all the attributes you mentioned. So that's, that seems to be a really hot growing area. It's really, because most of recruiting hasn't changed in so long. It's still very much what it was 10 years ago, 15 years ago. If you strip out LinkedIn, then nothing really changed much in 15, 20 years. So it's ripe for reinventing.
Yeah, it's usually the easiest way for enterprises to attack an immediate urgent problem is just throw more manpower at it, whether they have it or not, or if they outsource it, right? But that can be very expensive and not a long-term solution. And I think companies that have adopted platforms like Vetcher are in a better position to navigate whatever the hiring environment is in the future.
I want to dig a bit deeper in terms of B2B, right? Because I think folks, they find it difficult to kind of understand how the metrics might work, right? So you look at B2C, there's some like really neat and clean kind of vanity metrics, like millions of users or millions of products sold, right? You kind of have the McDonald's hamburger ticker, right? And it's very easy to kind of identify that scale. Do you have any kind of like insider tips for technologists to determine the progress a B2B company has made? Right? There's some companies out there that have two clients, but they're the most successful in the world. So
Well,
how does that work?
number one, and I think it's also kind of consistent with our thesis today, even more so than perhaps it was with our first fund back in 2011, is enterprise software sales is dead. So what does that mean? It means really the methodology of hiring, back to your point, SDRs and account executives, senior vice presidents, and heavy T&E, long, complex contracting and onboarding processes to get a software license closed and live to start turning it into billable revenue, right? Product-led growth is the future, right? Simple contracting, simple onboarding, pretty much self-service, quick conversion from one user to many. Once you get the users right bought in versus the executive that got bought in, and then ultimately are the users on board or not. One division maybe to start, but how do you quickly move across the entire enterprise with your solution? So first off, it's just your approach. What is your go-to-market strategy? How easy is your product to kind of self-guided from ultimately an onboarding and training perspective? But to your point, the metric that we think is most important, that we also encourage founders to focus on as well, if you're a SaaS software company selling into mid-market or large enterprises, is really your cash burn ratio, your ARR versus your cash burn. So we really focus on that. That crystallizes everything. If you don't understand what that means, I can explain it to you. It's, look, if you raised $3 million in capital in your seed round, what have you delivered in terms of ARR after burning through that 3 million? Did you deliver 1 million? Did you deliver 3 million? That ratio is critical. That tells the founder, that tells investors you're being more efficient or less efficient with investment. You don't need to just calculate a CAC ratio, which is just your sales and marketing investment versus your ARR, because it's very difficult to understand, that subset of your overall cash burn versus the total cash burn. So we really encourage executives to focus on that. But of course, month over month growth in ARR, the usage metrics that I talked about are immeasurably important to determine success versus simply, how many customers did I onboard this month? What is the net new MRR that I generated? What percentage churned over that period of time? All very important metrics to focus on. But at the end of the day, it all comes out of the wash with this ARR versus cash burn ratio.
Right. And for those that don't know, ARR is the annual recurring revenue, right? So it's subscription based. It's based on the kind of contract life or the subscription normalized for one calendar year,
So
right?
so your most recent month let's say, based on, you have 10 customers, you generated 100,000 in MRR, billable MRR in that month,
Right.
multiply that by 12, that's your ARR, your forward ARR. And then some could take it a step further and say, okay, you got your billable ARR, but you also have your contracted ARR that's not live yet. You have them signed, but they haven't gone live. So you add your contracted, not live, plus your billable ARR, and that's your kind of combined contracted ARR, which is a little more aggressive way of giving credit to that company based on their contracts already in place, even though they haven't been billable yet.
Got it. And so with this kind of current state of the economy, you mentioned this, you alluded to this earlier, right? So I think what a lot of people in the startup space don't realize is, there's kind of already clear benchmarks for best in class, best practice, right? Like the goal of many startups is to become a public company, right? And so you can often look at these like this cohort of software as a service companies that are already public, kind of look at their valuations, their multiples, um, and you kind of see like, oh well, like eventually it's gonna match that, right? Because that's the eventual output. Um, are there any other kind of tips like that that I think that you think is important for technologists to understand in terms of how to evaluate a B2B software as a service company in terms of kind of
I think one of the most important metrics, and we obviously look at these companies as a subset of the overall B2B technology companies that are traded and that Bessemer does an index on as well. But
right,
you look at net revenue retention rate, right? This is right, factors in everything, both growth, new customer acquisition, churn customers, expansion revenue with existing customers, and nets it all out and takes a look at that on a year-over-year basis or a quarter-over-quarter basis. And the companies that are most successful and actually have the highest forward multiples and are valued the highest are those that have that highest ratio. So you're retaining 140%. So on average, once you even take out churn, you are growing your revenue 140% versus a lot of companies might be growing revenue, but churning a ton. So their net revenue retention is much lower and they're making it up with net, with new revenue. But if you don't fix that fast, the new revenue ultimately won't make up for your churn revenue. So that net revenue retention rate is a key metric. For us, it's not as important, when you're in the seed stage or the pre-A or, maybe early A, because, a lot of these companies are still, trying to figure out their ideal customer profile, finding perfect product market fit. But we'd still like to see that number higher versus lower.
I mean, generally, let's kind of boil it down and get really kind of in the weeds. If I'm a job candidate, I get these like recruiter invites from a B2B company's recruiter. Like, are companies generally open about sharing their net revenue retention, the ARR, their churn rate? Like, how do you gauge that? Are there any signs when a company might not be?
Put it. I think there obviously is always hesitancy. I'm sure they're unless those numbers are astronomical, and maybe even if they are, they're probably not going to broadcast it to people that they may or may not know will work for them, but might go to a competitor.
Right.
So I think that's a question mark. I think, given the level of hire, I think it's absolutely appropriate to ask. You know, if it's a senior role in engineering or product or sales or marketing or finance or operations, I mean, without question, it's an appropriate question to ask. I mean, how much capital have you raised? Where is your ARR right now? You can start doing quick math, how efficient and effective this company is performing, and ultimately determine, are they going to be, capital efficient, or going to be in a difficult situation a year from now when they're out raising their next round of funding. And the same goes with the net revenue retention rate. Obviously that's indicative of how happy the customers are. If they're expanding and not churning, that's a positive versus the opposite. But I do think depending upon the role, it's going to be hard to get that information out.
Got it. So, I mean, what are other questions that prospective job seekers should start asking at when they start interviewing or considering working at a B2B SaaS company?
Yeah, well, look, I mean, I think the financial metrics are and performance metrics, I think, are important. And I think you should try to get comfortable that the company's in a good financial position to achieve its objectives. But I mean, number one, right, when I think most employees first have to be excited about what they're doing. I mean, number one, the vision, the product itself, what does it look like today? I would also think, getting insight on just some of the customer, like I said earlier, customer usage metrics. And, I'm sure they haven't, if they're coming from another company, they probably can use that as a comparison to kind of, oh, wow, people love your product, or don't. Based on that, and those might be less sensitive metrics versus some of the financial metrics. But I think, a lot of people make these decisions, hopefully once they get comfortable that the company has runway to pursue its objectives, based on who they're working for and what the company's trying to achieve, and if it, obviously if it's a good culture fit, and that starts with who you're working with and who you're working for.
I mean, you mentioned this a bit earlier when you were discussing kind of your investment thesis, right? Like, is it good to kind of see their track record of fundraising and see if their investors have continued to invest over time and like followed on, or is that maybe not the best realistic thing?
I think it's really, really important. I mean, one of the things, obviously, we're not alone, but most venture funds would love to invest in a second time or repeat founder that's had success and is more likely to have success the second or third time around. That's really important, so understanding who the founder is, who the co-founder is, and are the same investors that invested in his or her first company, back in this company. That's a huge sign that, okay, he obviously made that investor cohort happy, and they're back to support him in this business, and that's a great sign. And that's pretty easy to find out. You can dig into, LinkedIn and TechCrunch can tell you everything you need to know.
Now, I know this is not in your wheelhouse, but would you consider, given what you're talking about with the burn rate and some of these companies, some of these startups that took a lot of funds and really didn't have much revenue or any profits, to kind of take a look at some of those entities for takeover, acquisition, or purchase their software and technologies? Is that something you would ever think of doing, or that's too far afield from your specialty?
So we kind of hung up our operating boots, if you will.
Yeah.
Not and honestly, that was actually one of the most difficult transitions we needed to make with our first fund. We were CEOs, we were founders. We've been there, done that, and when we evaluated businesses, we quickly kind of put ourselves in the seat of CEO versus actually paying close attention to who we were talking to. We would get excited about the business, think of ourselves running it versus the team in front of us and their skill sets and aptitudes. And that was the first thing that we learned. We needed to kind of really just focus on who we're talking to and are they the right people to deliver the results, no matter what the idea was or what the business that they were pursuing was. But no, we definitely aren't in that direction, but obviously there's plenty of firms that are, and we think we're very helpful to them when they're making that decision. These are more of the mid-market private equity firms that look at these businesses, look at the teams, see an opportunity with the right operating leadership to get them moving in the right direction if they got great tech and great team, but they just haven't been able to execute perhaps at the level that maybe getting the right leadership and right funding behind it would have achieved.
I can imagine the conversations at the beginning. You're like all excited. You and your partners, you're all CEOs, have successful businesses. And then the poor CEO for the portfolio company is like, well, this is my job. Can I make my own decision here, please? So I could see how at first, probably really challenging for both sides, but then everyone gets in their groove and knows what they're going to do, right?
What I would say is, I think for that, for the founders, it's just, they love it because, they respect entrepreneurs. Obviously they need money, but
yeah,
they respect entrepreneurs. They know you've been in their shoes. And I think that's a differentiating factor of Revel versus not every venture capital firm. There's plenty of ex-founders and operators that are also now general partners or partners at venture funds, but it's been an edge. But I think for us, initially, to what I said, it was, we had to be careful to make sure that, we didn't use, get too, think that we were running the business versus the people that we were talking to. We always, obviously, we try to offer as much advice and as much, given our networks, both, with people and customers that we worked with over the years. I think we can be very, very helpful there. But to your point, it's a little bit of a tightrope. We don't want to, get too hands-on, but we want to provide them the necessary support that we think they need, plus they're asking for.
So where do you see the growth within the SaaS space? Like anything on the horizon that you say, oh man, I got to get involved in this area. That's kind of a hot growing space.
Yeah, I mean, I think what we've seen to date, and you're seeing obviously this changing, but you kind of had that first wave of horizontal SaaS solutions solving all kinds of enterprise use cases, across all industry verticals. Many of these incumbents that have built big market share through this kind of enterprise sales approach, like I talked about. But now you're seeing, again, these kind of product-led growth applications that we're focused on, that are, again, easy to onboard, but also this verticalization. You're seeing kind of marketing solutions or fintech solutions or sales automation solutions or HR solutions. You're starting to see, more verticalization, that it's bespoke to those specific industry, needs, whether that's in CRM or whether that's in marketing or whether that's in sales. For legal, they need a whole set of things that might be very different than retail or real estate or healthcare or travel or the media example that I gave you with placements. So we definitely think that you're going to see a lot more of that. We have a few of those solutions in our portfolio with Revel already, like Lawmatics, which happens to be kind of like the HubSpot for legal.
Wow.
And legal's a big enough industry to build a nice business with it. You know, it's not for every vertical, but healthcare is another industry, right? Massive within itself. And if you focus singularly on that, and I'll underline focus matters. You know, one of the biggest tricks for founders and CEOs early stage is there's so many people they can sell to. There's so many product features, but there's only so many product features they can build and build successfully based on the cash they have on hand. So by focusing vertically in the right industry sectors, you're in a great position to deliver a solution that's perfect for that target, and ultimately, you know, gain massive market share. I mean, you don't need to, you know, 10% is a layup. You know, you can get 50% market share for that particular market. And I think beyond the you know, the SaaS solutions, and I also, when I say SaaS, I'm talking about really any recurring revenue software solution. You know, that could be, you know, based, you know, recurring revenue generated based on transaction volume, you know, like for example, in the e-commerce space specifically, or just usage, product usage versus flat subscription fees, you know, also a way of generating recurring revenue. But also marketplaces, you know, obviously back to verticalization, but just generally speaking, obviously vertical marketplaces make a ton of sense. You know, we have one in, you know, alternative private debt with Percent. We have one in farmland with Acre Trader.
Wow.
Very, you know, again, markets that haven't automated, haven't leveraged marketplaces successfully because there wasn't the level of data or transparency available. So these guys created that and now automated that through kind of that buy side and sell side marketplace. So we think there's a lot more opportunity across verticals just in the marketplace category alone. And lastly, I would say you'll probably start seeing, and you're already seeing it, you know, just your SaaS technology solutions or your B2B technology software solutions, leveraging kind of what's happening with blockchain and other ways of monetizing their product for, you know, instead of being, you know, whether that's through tokenization or NFTs, you name it. So, you know, we're not investing in cryptocurrencies per se, but blockchain as an infrastructure, decentralization, edge computing as a methodology of delivering your product valuation, a proposition, or NFTs as a way to track assets and monetize assets and create liquidity are all very, very interesting and are very early in the formation for B2B for sure. But you're going to start seeing a lot more of it.
Got it. I appreciate the tips and tricks there and the preview kind of into this like really complex industry. And as you mentioned, there's just so many facets and sub industries within it, right? I think that is kind of the wonder of B2B there. So thanks so much, Joe, for coming on the show.
Well, happy to be here, and I really enjoyed the conversation.
Thank you, Joe. Wait, can we have one last question, a hypothetical question? So let's say there's a guy, Rick, and a guy, Jack, who heard this and are very excited about, you know, the VC space and the startup space. Is there some vertical that's kind of untouched that maybe you'd say, hey, there's an opening?
A specific vertical,
like something that you feel it's really, for whatever reason, really not
like a sleeper pick.
Exactly.
a sleeper pick.
And we'll block this out so everyone won't steal out the idea. So this one will edit out.
Well, I mentioned briefly NFTs and NFTs as a methodology for B2B technology and marketplace solutions to track physical assets, whether that's art, wine, real estate, for trading, portfolio management purposes, and then ultimately liquidity. Like, I think this is something you don't hear too much about, because all you think about when you think about NFTs are specifically around kind of music and sports memorabilia or
Bored apes.
art or whatever.
Apes.
Bored apes.
Apes, exactly. But the actual technology for tracking and managing and clearing physical assets is pretty amazing. And I think it's not limited to one or two verticals. I think it's across multiple verticals of asset classes that happen to be living in the physical and fiat domain right now.
Are you talking about like a company like Securitize that tokenizes everything you're talking about? Is that what you mean?
Yeah, it also could be. I know Securitize. I don't know the array of assets that they are securitizing right now. What they're focusing on right now versus what they have planned on doing in the future. But absolutely.
I'm just taking notes. Well, thank you so much, Joe. This is great. This because I think in part when we said at the beginning of the conversation, a lot of the folks on Blind, they're very entrepreneurial minded. So these are, this is something they're really interested in. I wouldn't be surprised, once we publish it, you might be getting calls. Hey, I'm from, X Apple, X Microsoft, X this, and now, have a whole lot of money that we made over the years looking to do something. So I think it's going to.
I'll let you know if they came in through this broadcast. I certainly will.
That'd be pretty cool. Excellent.
Right.
Well, thank you so much, Joe.
It was a real pleasure.
Take care.
Take it easy, guys, and have a great
nice
weekend,
everyone. Bye-bye.
All right. Bye-bye.